Hello and welcome everyone. This is Professor Siddharth Surana. I hope you guys are doing good. और मैं तो हमेशा मस्त ही रहता हूँ. Welcome to episode 1 of revision cum amendment lecture for CA final and of course for the common topics also CA inter students for May 2022 and November 2022 exams. May 22, November 22 exams, revision cum amendment lecture, 100% English, as I have already announced in the earlier one of the videos in which I released. I told you that this time my schedule is not permitting to do revision in 2 languages, so I will be doing the revision lectures only in English language. Anyways, you have to give your exam in English, so it is better that you learn in English. This revision lecture will be done from our new handwritten book Exemption 2.0. That's the book from which we will be doing our revision lectures. Okay, so I recommend that before you all start watching the video, if you have that book, it will be a little more comfortable for you. The book includes a lot of latest new memes and you will really like that book. For your revision purposes, it is the best thing that you can get. Separately, of course, once this revision lecture series is over, I expect that it is going to be about minimum 7 and maximum 10 sessions that we will be having in this revision. Minimum 7, maximum 10. As we are aware, every day evening 9 to 11 we will be doing it. Minimum 7, maximum 10 days. Once that is over, then we will start the MCQ season 3, where I will be covering the solutions of all the 1800 MCQs again from the new book that we have made for May 22 and November 22 exams. We will be covering all the MCQs with solutions. We will be covering them, so that should take another about 10 days minimum, maximum 15 days. So in a total of about minimum 17 and about a maximum of 20 to 25 days, we will be finishing both revision series and MCQ series. Before I start the revision, one thing I would like to very clearly tell you, that this revision book cannot be the only book from which you study. Okay, if this book was enough to do everything, then why will I write 4 books for CA final? So I have a main textbook, I have a question answer book, I have a handwritten revision book called Exemption 2.0, and I have MCQ book. All of them have their own importance. So if you want to study, you have to study in detail first time. You will need the main textbook. You will need the question book to practice the question. You will need the MCQ book. And then you can use this book for revision. Your revision will happen very fast. One day before your exam, you will be able to revise the subject twice, in fact. Okay. So, every time you approach the subject, if you have been one of my students from any of my physical lectures or last 2 years, any of my online Zoom live batches, if you have been my student, I must have told you already in the lectures. Okay. So, why am I saying this is because institute has proved with the results that the subject and the exams are under their control. So basically over smartness is not going to help us out here. Okay, so you have to follow instructions, and instructions are given in the full course lectures. Habit of some students is that they don't want to give time or energy or effort. They don't want to attend full course lectures. They don't even want to take crash course. They don't want to spend time. I am not talking about the money part here. They don't want to spend time. They think that it is too time consuming. They think that it is too much of effort, and thus they directly want to watch only revision lectures, only from one book, only revision. We will finish DT in 2 days, and then if you expect that you will get exemption, obviously it is not possible. Okay, so you have to first watch all the lectures, full course, then you will have to come to revision. This is going to be, this disclaimer is basically, in short, this is only revision. You don't expect me to do everything in detail. There won't be any explanation of any concept or logic. I am only going to revise things that have already been taught in the full course lectures. Of course, the amendments will be discussed. That is okay. But I am not going to do the existing concepts in detail like I do the full course. And if you want everything in detail, then go take the full course. Why you are watching only revision lectures? Okay. So I will be very clear on this. This is only revision. The revision will be done from our handwritten book Exemption 2.0. The order of the topics is same as all our books. We have all the books in the same order. volume 1 will cover these 16 chapters. Then we have volume 2 which will cover another 16 chapters ending at transfer pricing. And then we have the intermediate portion where we have heads of income, clubbing set of deduction. That is what we will be doing. So we will be doing these 2-hour sessions every day, and with which we will finish revision first, and then we go to MCQs from our handwritten book, directly starting from the first chapter, Introduction to Income Tax, and the first meme. सबको टैक्स देना होगा, not chanda. Chanda is donation, political donation. Tax. Who are the assessees? The following are the assessees liable to tax under income tax, and the rates of tax will be studied assessee by assessee. So the first assessee that we have is individual, of course, natural person, human being, liable to pay tax. Hindu undivided family, HUF, 4 generations of a Hindu family have got right over the family assets, liable to pay tax. Every time we cover partnership firm, it will also cover LLP except presumptive taxation, and over there also we have an amendment. So what is the amendment? We will see when we come to the partnership firm topic. Companies, of course, are liable to pay tax. AOP, BOI, association of person, body of individual, local authority, artificial juridical person, 7 assessees, all are liable to pay tax. What are the tax rates applicable for previous year 21-22, assessment year 22-23, that is the applicable attempts of May and November 2022. These are the 2 attempts for which we are making these revision lectures, May 22, November 22, and thus the applicable previous year is going to be previous year 21-22, assessment year 22-23, and we start with tax rates first. First, I will be doing tax rates of individual, which is also the tax rate for HUF, AOP, BOI, artificial juridical person. Individual, HUF, AOP, BOI, artificial juridical person. These are the tax rates that I am going to be covering with you. As far as AOP, BOI is concerned, other than the slabs, there is also one small concept on tax calculation about MMR being applicable that I will be covering in the MCQ lectures. In partnership firm chapter, I will be covering MCQs also on AOP. So that will be covered in that part. Otherwise, following are the income tax rates for individual, HUF, AOP, BOI, AJP. Individual, HUF, AOP, BOI, AJP. Following will be the tax rate. First, we will start with an individual who is less than 60 years of age. Normal individual, because we are all aware that senior citizens, super senior citizens, that is people of the age 60 to 79, senior citizen, 80 and above, super senior citizen, for them separate tax rates have been prescribed. So this discussion is only about individual less than 60 years. Second, the same rates will be applicable to non-resident irrespective of age. So non-resident of 60 years or 80 years or 100 years, these rates will be applicable same as less than 60 years, because senior citizen and super senior citizen benefit of higher basic exemption limit is going to be available only and only if the assessee is resident. The category is not senior or very senior. It is resident senior citizen and resident very senior, resident super senior citizen. These are the 3 categories of individuals. So non-resident of any age will fall in this category, and HUF, AOP, BOI, Lions Club, for example, an artificial juridical person, a robot if he has earned income. This is also an example. So I have tried to make the book as interesting as possible for students so that these pictures can keep certain things fresh in your mind. Lot of memes also coming up. So those who have the book already are aware of this, and those who don't have the book, you can of course place the order on the website of Coppergate Educare and you will get this book. It will be very useful for revision. Okay. So resident individual less than 60 years will come here. Non-resident of any age will come here. HUF, AOP, BOI, artificial juridical person will also come here. The tax, first we will finish the old regime completely. This is only revision. Then we go to the new regime. First 2,50,000, no tax. That is the basic exemption for these people, because we are aware resident senior and resident super senior have got higher basic exemption. 250 to 5 lakh, 5% is going to be the rate of tax. So the slab of 250 and rate will be 5%. Thus the tax that we get in these slab, of course, I know you are aware of this, 12,500. Next 5 lakh ka slab, which is from 5 lakh to 10 lakh, rate of tax 20%, no change here. So the tax that we get in this slab becomes 1 lakh, and after 10 lakh, anything, it can be 12 lakh, 15 lakh, 20 lakh, 1 crore, 100 crore, 1000 crore. The rate of tax on income after 10 lakh is going to be 30%. So first 250 basic exemption, then next 250 5%, next 5 lakh 20%, and after 10 lakh, 30% is going to be your rate of tax. However, if you are a resident, so you have to focus on the condition that is applicable. The moment your assessee becomes non-resident, automatically the provisions applicable will change. So if you are a resident who is 60 or above, so exact 60 will be covered and less than 80, because exact 80 will go in the third category of individual, that is resident super senior citizen. So it is this category is going to be 60 to 59. If I have to define this category exactly for you, 60 to 79, not 59, 60 to 79. So what are the three categories of individual? 0 to 59, 60 to 79, 80 and above. 0 to 59, 60 to 79, 80 and above. But 60 to 79, 80 and above only if resident. If you are non-resident, you come in the first category itself. If you are a super senior citizen, only change being your basic exemption will change to 3 lakh rupees. So additional 50,000 you don't have to pay tax, and that 50,000 is removed from the 5% bracket. So 5% bracket will only be 3 lakh to 5 lakh, only 2 lakh rupees. Here we have 250 taxable at 5%. Here we have only 2 lakh taxable at 5%. Accordingly, 50,000 at 5% being the difference of 2,500, and thus the tax that we get in this slab is going to be only 10,000. The tax in this slab is only going to be rupees 10,000, and that's the change. Here it is 12,500, here it is going to be only 10,000. The rest is same. From 5 lakh to 10 lakh it will be 20%, and after 10 lakh it will be 30%. So the only change is basic exemption increases to 3 lakh rupees. And if we talk about the third category, as you have understood, super senior citizen, exact 80 will also fall here. 79 will be the second category, exact 80 will be the third category. Only if you are resident. If you are non-resident, you go in the first category, 2,50,000. If you are super senior citizen, you get 5 lakh basic exemption. So first 5 lakh no tax. So whatever is the 5% tax, whether it is 12,500 of the first category or 10,000 of the second category, that tax is not going to be applicable to you. This tax will not be applicable. Your tax will start directly in the 20% bracket, 5 lakh to 10 lakh, directly 20% bracket, and after 10 lakh you will be having 30% bracket. This is going to be the basic tax calculation of the three categories of individuals we have understood. Normal individual less than 60 years, will also include all non-residents any age, will also include HUF, AOP, BOI, artificial juridical person, because the second and the third category of individual only if you are a resident. And these are the slabs. Apart from that, we are all aware of chapter 12 special rates of tax, starting from section 110 ending at 115 BBG. These are the this is the section range where you will get your 111A of short term capital gain, your 112 of long term capital gain, 112A if it is stock market long term capital gain, your casual winnings. This is revision class. So I know you are aware that there are some incomes which are not taxed at slab rates. Separate rate of tax is prescribed for them, and for which we have our separate chapter, special rates of tax. In that chapter we will be discussing the rates, special rates, but the tax that we have calculated by applying the slabs over here will be called our basic tax liability. We all know that basic tax is not your final tax liability. It will undergo change. We have the concept of rebate, surcharge, HEC. Let's discuss the three concepts one by one. What we have calculated till now, whether normal or special is only basic tax. Let's go ahead to learn the other concepts. Section 87A will give you rebate. Rebate means we will get reduction from our basic tax liability. Basic tax liability will be reduced. What are the conditions? Condition 1, you have to be a resident. So non-resident will not get higher basic exemption also if senior citizen, and will not get rebate. Rebate is available only and only if you are a resident. Second, you have to be an individual. Rebate will not be available if you are HUF, AOP, BOI, company, firm. Rebate is available only and only if you are individual, and your net taxable total income is up to rupees 5 lakh. Up to means less than or equal to, means if your income is equal to 5 lakh also the condition is satisfied. Be very careful about this. Whether less than or greater than everyone knows, but what is the treatment of equal to? For example, less than 60 is normal individual, more than 60 is senior citizen, but exact 60 is what? People don't pay attention to that. Less than 80 is senior citizen, more than 80 is super senior citizen, but exact 80 is what? You should always pay attention to, always pay respect to, equal to. Okay, so if you are resident individual, income up to 5 lakhs, less than or equal to 5 lakhs, not exceeding 5 lakhs, anything you say, all are right, up to 5 lakhs, resident individual income up to 5 lakh, then you will get a rebate. Rebate of your actual tax. Actual tax you will be calculating as per these slabs. It can be normal, it can be special also, whichever, or 12,500, whichever is lower. Normal tax, actual tax calculated, or 12,500, whichever is lower. So if your tax liability is more than 12,500, you get maximum rebate of 12,500, and if your tax liability is less than 12,500, that will fully become your rebate, tax will become 0, and this is for people like, rebate is for people like poor people having income up to rupees 5 lakh. But after rebate, we also have the concept of surcharge. Surcharge is for people like, no need to even take the name, surcharge is for people like him. So we are on the same page. Surcharge for rich people, if your net taxable total income is greater than 50 lakh and up to rupees 1 crore, then there is going to be a surcharge of 10%. 10% is going to be your surcharge. So again, pay attention, pay very careful attention. If your income is exact equal to 50 lakh, no surcharge. Surcharge will start only and only after your income crosses 50 lakh. More than 50 lakh, exact 1 crore, 10% surcharge. More than 1 crore, equal to 1 crore will fall in 10%. Pay careful attention. Equal to 1 crore will fall in 10%. If it is more than 1 crore and up to rupees 2 crore, then surcharge will be 15%. Equal to 2 crore will come here. More than 2 crore up to 5 crore, 25%, and more than 5 crore will be 37%. These are not slabs. You look at the income figure. Income 80 lakhs, 10% surcharge. First of all, let me start like this. Income 40 lakhs, no surcharge. 50 lakhs, no surcharge. 80 lakhs, 10% surcharge. 1 crore, 10% surcharge. 1.5 crore, 15% surcharge. 2 crore, 15% surcharge. 2.5 crore, 25% surcharge. 5 crore, 25% surcharge. 5.5 crore, 37% surcharge. Only one rate will apply, that depends on your total income. If your total income is more than 50 lakh, 10%, more than 1 crore, 15, more than 2 crore, 25, and more than 5 crore, 37%. These are the rates of surcharge, and this, observe carefully, in rebate they give you only for resident individual. Only for resident individual. But here, surcharge will come for individual, HUF, AOP, BOI, AJP, everyone. Same surcharge. Company firm also have surcharge, but that we will discuss later. These are rates of individual HUF, so we are only talking about them. Surcharge comes for all assessees. Rebate is only for individual. Surcharge is for all assessees. Second, rebate is only for resident. Look at surcharge. Have we mentioned anything? No. That means surcharge will come whether you are resident or non-resident. Surcharge will be applicable for both. Rebate is applicable only for individual. Surcharge is applicable for all assessees. Rebate is applicable only for resident. Surcharge is applicable for resident, non-resident, both. And what are the rates? 10, 15, 25, 37. For these assessees, these are the rates. Company rates we will discuss later with surcharge. Tax and rates both. Firm rates with surcharge we will discuss later. These rates are only for individual, HUF, AOP, BOI, AJP. However, these two extremely high surcharge rates, which two? The top two, 25 and 37. These two surcharge rates will not be applicable to the tax that you calculate on the following incomes. Which incomes? Short-term capital gain under section 111A, where stock market trading takes place, STT paid, basic tax is calculated at 15%. This is revision lecture. 112A, long-term capital gain on stock market trading, first 1 lakh 0%, balance 10%. 10% on the excess over 1 lakh. So if your income is 5 lakh, 4 lakh into 10%. If your income is 10 lakh, 9 lakh into 10%. First 1 lakh nothing, balance 10%. Then capital gain for FIIs under section 115 AD, covered in special rates of tax, and dividend income, which was earlier exempt but now taxable. On these incomes, 25 and 37 will not be applicable. Even if your income is 10 crore, 20 crore, 40 crore, 100 crore. The tax that you, first of all, let me be clear, surcharge is not calculated on income. Surcharge is calculated on your basic tax liability. So first step will always be to calculate our basic tax. After we calculate our basic tax, then we apply surcharge. you split your basic tax. What is the basic tax of these incomes and what is the basic tax of other income? These incomes, other income. These incomes, other income. The incomes that are stated over here, these 4 special incomes, 111A, 112A, 115AD dividend, 111A, 112A, 115AD dividend. On these 4 incomes, whatever is your basic tax, the maximum surcharge will be 15%, 25 and 37 will not be applicable. Even if this income is 10 crore, 50 crore, supposingly I have got short-term capital gain 100 crore. The surcharge, first of all, on that 100 crore, I will calculate basic tax. This is one mistake that you can make. Please be careful. First of all, on that 100 crore, I will calculate 15% tax if it is this case, or 10% on excess over 1 lakh if it is this case. The capital gain tax under 115AD, the tax of dividend income. On that tax, when we apply surcharge, if my income is 100 crore, normally our answer will be 37% after 5 crore. But here it will be maximum 15%. The surcharge of these 4 incomes will not be more than 15% of basic tax. So first of all, what is surcharge? Extra tax for super rich people. The income crossing 50 lakh rupees, the moment it crosses 10%, then it crosses 1 crore, then 15%, then it crosses 2 crore, then 25, and it crosses 5 crore, then 37. But on these incomes, 25, 37 will not be applicable. We will stop at 15. So split the basic tax. Other income can have any tax and any surcharge. These incomes will have their own tax, and on that highest rate of surcharge will be 15%. Highest will be 15%. This is the line till here. Okay, let me be clear that even if your NTTI is more than 2 crore or 5 crore, surcharge of 15% will be calculated on the tax on these incomes. We stop here. This is what I have explained. Whatever be your total income, the surcharge of these incomes will be highest, maximum 15%. And now I have one more line over here, under which if my income is crossing 2 crore only because of these incomes, supposingly this is 100 crore and my other income is only 1 lakh salary rupees, 1 lakh rupees salary, nothing else. My other income is only salary of 1 lakh. That means the other income is less than 2 crore rupees. In that case, even if my total income is 101 crore or 100 crore and 1 lakh, the total surcharge will be maximum 15%. My surcharge will never be more than 15%. I will do this with you with the help of 2 examples. If I cover 2 examples with you, you will be able to understand what exactly I am trying to tell you when I am trying to tell you these things. What did I tell you? That on these 4 special incomes, highest surcharge is going to be 15%. Let me explain. Okay, let's take these 4 special incomes and we add our other incomes. If you take 4 special incomes and you add other incomes, you will get your total income, or let me call it net taxable total income, NTTI. 4 special incomes covers 111A, 112A, 112, not 112, 112 is an amendment this year, so it will be applicable next year from May 23, and dividend income. 4 incomes. Okay, and other income can be anything, salary, house property, etc., anything, PGBP. Other income can have anything. Okay, let's take our first example. Say we have short-term capital gain, stock market, 8 crore rupees, and I have got salary income of 1 crore rupees. So can I say my net taxable total income will be 9 crore? At 9 crore, 37% surcharge is applicable because more than 5 crore means 37% will be applicable. Yes or no? But come check here. For this income, first calculate the tax on this income, and on this tax, the maximum surcharge can be 15%. It cannot be more than 15%. Highest surcharge on this income will be 15%. Or in these special incomes, surcharge cannot exceed 15%. That's my first line. On these incomes, surcharge cannot be more than 15%. The highest surcharge is going to be 15%. Is that clear? So are we done with this, that the surcharge of these incomes will be only 15. Now come here. First step will be tax. Never make this mistake. Surcharge will never come on your income. Surcharge will always come on tax. So calculate tax on the income. Apply slabs, calculate tax. This is special rate, this is normal rate. Calculate tax. And now comes the time to apply surcharge. Now you will say, sir, here it is maximum 15, but here we should apply 37, no, because income is more than 9 crore. Now comes the importance of the second line. If on exclusion of these incomes, the NTTI is 2 crore or less. Exclusion of these incomes. Which income? Special income. Exclude this. Remove this. Then what is the remaining income? Less than 2 crore. Then in that case, your entire surcharge will be 15%. Here also, your surcharge will be 15%. This will never be more than 15. Here highest is 15. Here you check whether this income alone has crossed 2 crore rupees. Then only 25 will apply, or 5 crore rupees, then 37 will apply. If the total is crossing 2 crore because of this, imagine this is 9 crore because this is 8 crore. If this was not there, then this is less than 2 crore. This income is crossing 2 crore. What I mean to say is, this total income is crossing 2 crore because of this. This income is not helping us to cross 2 crore rupees, and thus your total surcharge will be 15% on everything. But if I have to give you another example, supposingly this income is 1 crore and this income is 8 crore. Now total is 9 crore. Now look at the total. Then our answer will be 37% surcharge because it is more than 5 crore rupees. But one thing we are sure, on this first step will be calculate tax. I will repeat this again and again. Surcharge is calculated as a percentage of tax, not as a percentage of income. So calculate tax. That you will have to do here also. Calculate tax. Okay. Now at 9 crore we have 37%, but on this we have already decided maximum surcharge will be 15. It can never be more than 15. Highest surcharge is going to be 15%. Now come here. Is this income alone crossing 2 crore? Check. Last time alone it was 1 crore. Total was more than 2 crore because of this income. If you remove this income, the total will also be less than 2 crore. But this time the change is that this income alone is crossing 2 crore. In fact, it has crossed 5 crore also, and thus here the surcharge will be 37% of basic tax. So normally your surcharge, if we ignore the concept of special incomes, your surcharge is 4 levels: 10, 15, 25, 37. 10, 15, 25, 37. Based on income crossing 50 lakh, 1 crore, 2 crore, 5 crore. 4 rates of surcharge. But on these incomes, we will not apply 25 and 37. Here, our maximum highest total will be 15. We will never have more than 15% surcharge on basic tax here. So this topic should get over. Here we will never put more than 15. Now come to this side. Check. Is it crossing 2 crore on its own or no? Here it is crossing. So apply 25, 37. Here it is not crossing. So apply 15 on everything. These are the two lines that we have written here. Even if NTTI is more than 2 crore, 5 crore, surcharge will be 15% on the tax that is calculated on these 4 incomes. But if on exclusion of these incomes, if NTTI has crossed 2 crore, is less than 2 crore, then in that case, surcharge will be 15% on your entire basic tax liability. 25, 37 will not be applicable at all. This is how we will apply the rate of surcharge, and be careful about the following things. 1, it comes for all assessees. Company firms, we have not yet discussed basic tax, so we will discuss surcharge with basic tax. But for all other assessees, these are the rates of surcharge. Second, it will come for resident, non-resident, everyone. And third, your equal to is not covered. It has to be greater than 50 lakh, greater than 1 crore, greater than 2 crore, greater than 5 crore. Okay. And then we also have a concept of marginal relief under surcharge. If your income is exceeding the surcharge threshold, marginal, slight increase, still surcharge will come. Today, if I have 50 lakh and 1 rupee, then I will have surcharge of 10%. At 50 lakh, I will not have exact 50 lakh. But if I have 1 rupee also, okay, let's ignore 1 rupee because you will say, sir, round off to 50 lakh. Okay, 50 lakh and 10 rupees. 50 lakh and 1000, I will have 10% surcharge because it has exceeded 50 lakh. And this will levy unnecessary additional tax burden on me. With the help of an example, I will take two examples. First assessee having income of exact 1 crore rupees. Second assessee 1 crore and 5,000, exceeded 1 crore. So at least I hope you have understood this much, that here the surcharge will be 10% because equal to 1 crore is 10%. More than 1 crore will be 15%. That's the difference. Like equal to 50 lakh 0, but more than 50 lakh 10%. So 1 crore income 10% surcharge. 1 crore 5,000 then 15% because it is more than 1 crore. Everyone has understood that. But surcharge is on basic tax. So step 1 is going to be always to calculate what first? First step is going to be calculation of basic tax. So if you apply the slabs that I have already taught you, you will get 28 lakh 12,500 here and 28 lakh 14,000. Difference is this 5,000 going in 30% bracket. 1,500 difference is already visible here. Now we apply surcharge at 10%. So we get 281 250 and here we get 422 100. Accordingly, the basic tax plus surcharge 3093 750 here and 3236 100 here. And here understand what is happening. The income has increased only by rupees 5,000. Clearly visible that the difference is income. The difference in income is only rupees 5,000. But the difference in tax is coming to 142 350. How can your tax increase by 1,42,350 when your income has increased only by 5,000? Imagine I am this person, you are this person. I have income of 1 crore, you have income of 1 crore 5,000. I am paying 3093 750. Your income is only 5,000 more than mine. No, that is the only difference between my income and your income. And you are paying 3236. That means your income is only 5,000 more than mine, but you are paying 1,42,000 more tax. That is the nonsense. And thus, the difference in tax. One line I will explain the concept of marginal relief. One line, record it if you want. The difference in tax cannot be more than difference in income. I repeat, the difference in tax cannot be more than the difference in income. If income is exceeded by 5,000, then tax can increase, tax will increase only and only by rupees 5,000. If income has increased by 5,000, tax cannot increase by more than rupees 5,000. Income has increased by 5,000, tax will increase by maximum 5,000. So if this is 3093 750, here it will be maximum 5,000 difference and thus 3098 750, and the difference figure will be subtracted. That is called marginal relief. I repeat that line. If income has increased by 5,000, the tax difference can also be maximum 5,000. The difference in tax cannot be more than the difference in income. And thus, if this is 3093, this will be 3098 and the difference will be removed by way of marginal relief. That's your total concept of surcharge. 4 cases where 2 surcharge 25, 37 not applicable, and if income is crossing only because of them, then entire income, the tax that you calculate 15% surcharge. And the concept of marginal relief is also hereby discussed and over. And last concept, cess. As we are all aware of the concept, whatever is the tax that you calculate, basic is the first step always. Only after you calculate basic, you check for rebate if any. 3 conditions: resident individual income up to 5 lakh, add surcharge if any, only if income is more than 50 lakh. And we all know rebate and surcharge can never come together, because rebate comes for income up to 5 lakh and surcharge comes for income more than 50 lakh. So they cannot come together. But apply all these steps, calculate all this tax, and after you calculate this, the cess is going to be 4% of the amount so calculated. 4% of the basic tax minus rebate plus surcharge is going to be your applicable cess. So if your tax is coming to 100, you actually pay 104. If your tax is coming to 200, you pay 208. That is the applicable cess for all assessees. In fact, the best part about cess is 1, it comes always, and 2, it always comes at a fixed rate of 4%, and 3, it will come on the total of basic plus surcharge, rebate if applicable, whatever is applicable. This is how tax is calculated as per the old regime, the traditional regime. We are all aware that there are 4 sections of new regime. 115 BAA and BAB is for companies. So we will talk about these 2 sections in MAT chapter, where we discuss the tax rates of companies, and 115 BAC BAD. BAC is for individual HUF, BAD is for resident cooperative society. We will discuss them here. Right now we have finished the old rates of individual HUF. So then we will also finish the new rates of individual HUF. One very particular and specific thing that you have to check and observe for 115 BAC carefully. There are 4 sections of new regime. BAA BAB is for companies, BAC individual HUF, BAD cooperative society. In 115 BAA they mention domestic company, BAB they mention domestic company, BAD they mention resident cooperative society, but BAC they write only individual HUF, only individual HUF. BAA BAB domestic company, BAD cooperative society resident, but BAC only individual HUF. This means whether you are resident or non-resident, both are going to be eligible for the new taxation regime. And of course we all know that the new regime is optional. We all know the funda of the new regime, that there are some tax benefits that you have to leave. Your SEZ benefit, 35 AD, scientific research, this is revision lecture. You are expected to know that these are the deductions: 10 AA, 35 AD, scientific research, additional depreciation, chapter 6A deduction. Leave all those benefits. NTTI will increase and lower rate of tax. Similar to long-term capital gain, 10% without indexation, 20% with indexation, something similar. Leave your benefit and pay tax at lower rate. That is the common concept of all the 4 sections of new taxation regime. BAA, BAB, BAC, BAD, all 4 have the same logic, the same idea behind them. So let's discuss BAC. If we discuss BAC properly, BAD will become easy, and in the future chapter MAT, even BAA, BAB will become easy. First, this is for individual HUF, resident, non-resident both. Only here, other places domestic, resident mentioned. Second, this is going to be optional. New regime is never going to be compulsory. Now what are the rates? Observe carefully. Slabs are increasing by 250, rate increasing by 5%. So if you carefully observe, first 2,50,000, what was the rate in the old regime also? 0, basic exemption. In the new regime also 0. So is there any saving? No. Same rate in old and new. In fact, senior and very senior citizen are having a loss now, because they have higher basic exemption limit if resident in the old regime, but here the basic exemption, all individuals, all HUF, basic exemption in new regime is going to be, all individual, all HUF, basic exemption in new regime is going to be 2,50,000 rupees. In fact, they have a loss. Next, 250 to 5 lakh, 5%. So no change. If you observe carefully here, till here, the tax rate as per old regime and new regime is going to be same. No change. 5 lakh to 750. Observe, slab increasing by 250, rate increasing by 10%. In the old regime, if you are aware, these two are taxed at 20%. 5 lakh to 10 lakh, 20. 5 lakh to 10 lakh at 20. So here we are saving 10% and here we are saving 5%. This is the savings that we are having in the new regime. So 5 lakh to 750, 10%, 750 to 10 lakh, 15%. After 10 lakh in the old regime we have 30, till infinity we have 30. Here we have till 1250 we have 20%, 1250 to 15 lakh we have 25. So once again, old regime 30, new regime 20. Savings of 10, old regime 30, new regime 25, savings of 5% and more than 15 lakh. In old also it is 30, in new also it is 30, no change. So the only tax savings that will take place is going to be of this much area, 2,50,000 into 10%, savings of 25,000. 250 how I got? Slab amount is 250 in all the slabs. Observe, no, all the slabs are of 250, 250, 250. Okay. So here old regime I have 20% tax, new regime I have 10% tax. So I save 10% of 250, 5% of 250. That is how I am counting my savings. So let's continue. Here I save 5% of 250, 12,500. Here I save 10% of 250. So 25,000 and 5% of 250, 12,500, total savings of going in new regime. We have discussed it in full course. We have discussed it in crash course. New regime can save maximum 75,000 rupees. Highest tax savings for assessees falling in new regime will be 75,000. But the benefits that you forego for this: SEZ deduction, scientific research, 35 AD, additional depreciation. Chapter 6 says something that will affect all of us. SEZ and 35 AD cannot be for everyone. But chapter 6 says something which is applicable to poorest of poor and richest of rich. Everyone. The loss can be infinite. One line I will speak. Any assessee moving from old regime to new regime, savings can be maximum 75. It cannot be more than that. Loss can be unlimited. Your deductions that you are foregoing can be crores of rupees and you are going to lose that. Okay. Apart from that, a very big advantage, hidden advantage. Tax savings will be only 75,000, but you will not be having alternate minimum tax. AMT will not be applicable, and for companies MAT not applicable. See, companies have MAT, but in new regime MAT not applicable, and other assessees have AMT. In new regime, AMT is not applicable. In other words, MAT AMT will not be applicable for any assessee in new regime, whether 115 BAA, BAB, BAC, BAD. MAT AMT not applicable. But what will be applicable? Surcharge, same rates, 10, 15, 25, 37. 25, 37 not applicable for certain incomes. Marginal relief, absolutely same, with a small thing to be noted, that NTTI will be calculated as per new regime. I told you that we have to forego our tax benefits. So, of course, the NTTI in new regime will be higher than the NTTI in the old regime after foregoing those tax benefits. On that, so it is possible that in old regime your NTTI is 40 lakhs, no surcharge. In new regime your NTTI is 60 lakhs. So, you have to apply 10% surcharge. Rate is same, but NTTI of new regime says best 4% always on basic plus surcharge, and this is important for all the 4 sections again in new regime. Any assessee opting for new regime, special rates will apply. What we will be doing is, net taxable total income will be split into 2 parts. Normal income will be normal rates and special income. Special income will always be taxed at chapter 12, whether it is your long term capital gain, short term capital gain, any of this. Special income will always be taxable at special rates. Special income will always be taxable at special rates. Normal income you can decide old or new. So the option of old slabs or new, old or new, old or new, old or new, old, that is available only for normal income. Special income will always be taxed at special rates. So that is special rates applicable, surcharge applicable, cess applicable. What is not applicable? Alternate minimum tax will not be applicable for company. MAT, minimum alternate tax, not applicable. And as far as rebate is concerned, honestly speaking, rebate is applicable. But sir, why have you not written? Rebate is applicable only for income up to 5 lakh. And if you observe carefully, income up to 5 lakh, there is no change. Whether I am in old regime or new regime, income up to 5 lakh rates are same. So any assessee who has income up to 5 lakh will remain in the old regime. Why will he forego his tax benefits unnecessarily? Where my rates are not changing, I will remain in the old regime. So in short, assessee eligible for rebate will not come in new regime. He will remain in old regime and pay as per old, and that rebate is applicable. Are we clear on that? In case you are in new regime, rebate concept is same, income up to 5 lakh. Resident income, resident individual income up to 5 lakh. Actual tax or 12,500, whichever is lower. Absolutely same concept. Okay. Next, we all know that new regime is optional. Option has to be exercised on or before the due date of filing of return of income. You have to decide before the due date. If you don't apply for the option before the due date, by default you will fall in old regime. This option will be available only and only if you have opted, only and only if you have opted, and that has to be done on or before due date of return filing. In the other 3 sections, BAA, BAB, BAD, BAA, BAB, BAD, domestic company and cooperative society, resident cooperative society, same rule, option to be exercised on or before the due date of return filing. But there they say once taken cannot change. Once taken cannot change means it is like your CA course. You can go from old regime to new regime. Once you go to new regime, you can never come back to old, never come back to old, never come back to old. But 115 BAC is different. 2 points. First point we already saw. This is applicable to non-residents also. That is first point of difference. Second, your option can be changed and it is a little confusing. I will be explaining how this change will work. But before that, I should be clear about the following things. You should be clear. I am already clear about the following things. 4 sections of new regime. 115 BAA, BAB, BAC, BAD. What are the common points in these 4? Common point 1. Tax rates will reduce. Tax rates in new regime are lower than old regime. Second, but you have to forego certain tax benefits. So your NTTI will increase, then only rate will reduce. Third, Chapter 12 special rates will be applicable. Whether old or new regime, special income will be taxed at special rates. Fourth, MAT AMT is not applicable in new regime. Fifth, these provisions are optional. You can choose to stay in the old regime. Sixth, in all the 4 sections, option has to be exercised on or before the due date of filing return. So these 6 points are common in old and new regime. 6 points are common. 6 points are absolutely common. What is different? And listen, difference is only in 115 BAC. Only in BAC. BAA, BAB, BAD. Domestic company, resident cooperative society. They are all same. The difference is only here. First difference. This section covers resident, non-resident both. Those 3 sections cover only domestic companies or resident cooperative society. Second, in this section you can change your option. Those 3 sections they say option once taken cannot change, will apply for forever in future. But here you can change. An assessee who is not having business income, for example, my brother is a salaried employee. Earlier he used to work for Godrej Properties, then Godrej Consumer Products, then Amazon. Now he has got a new job in a company called Zepto. It delivers groceries in a few minutes at home. He is now working with that company, Zepto. Salaried employee, not having PGBP. My mother has got only rent and interest income. Not having PGBP, you can change the option every year. Individual can change the option every year if not having business. Not having income from PGBP. Matlab, the other 3 sections you cannot change. Once you go in new, forever new. You cannot come back to old. But here, you can change every year. That means you can take not having PGBP, not having PGBP. You can take new regime or old regime every year. So you can take old, new, new, old, 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 new, 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 old, old, new, 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 old, new, old, new, old, new, old, new, old, 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 new, 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 old, new, old, new, old, new, old, new, old, new, old, new. You can change your option every year. Individual HUF not having business. Okay. So companies and cooperative societies cannot change. Individual having business we will discuss, but not having business change every year. Now let's talk about assessee having income from business or profession. Assessee having income from business or profession. Individual HUF. You can exercise your option on or before the due date. That means you can go from old to new. Sir, I don't like new, sir. I want to go back, sir. You can go back to old. You can go to new, come back to old. But only once. Only once. You can come back new to old. But now new not available to you. That means not having PGBP is easy. Every year you can change. This part is clear. Let's talk about having PGBP. Go, allowed. Old to new. Come back, allowed. But now you cannot go. So this is like, this is something that you can change every year. So this requires no explanation. 115 BAA, BAB, BAD are like your CA course. I told you, you can go from old to new, but then you can never come back. Cannot be changed. This is like entry in a cinema hall. Think about it. You are allowed to buy ticket and enter. Very good. Go inside. You don't like the movie, you come out. But it is single entry ticket. So now you cannot go back again. Now you will not be allowed to go back again. So old to new allowed, new to old allowed, but now you cannot go back to new. But if you stop having business, cease means to stop. If you stop having income from business profession, then you will become this assessee. And assessee not having PGBP can change the option on a year basis. So if you have PGBP, you can go to new, come back to old, but you cannot change, cannot go to new again. But if you stop business, then you can change every year. And if you don't have PGBP already, you have the option of changing every year. This is the applicability only in 115 BAC. Other three sections are very clear. Old to new, and then lifetime new, old not allowed. Very easy. Okay. That's one difference between 115 BAC and the other three. And second, I already told you. Here we cover resident, non-resident both. There we cover only resident and domestic. Resident cooperative society, domestic companies. Remaining points are same. Which points? Less tax rate, forego tax benefit, MAT AMT not applicable. It is going to be optional. Option to be exercised on or before the due date of return filing. And special rates, very important. Special rates will continue to apply. And now, what are the tax benefits to be foregone? You will have to leave all these benefits, all these exemptions, deductions one by one. What? 10.5 leave travel allowance, which is available against your salary. It's an exemption. Your boss gives you LTC and you take an exemption. You will not be allowed in new regime. So, what is this list? Tax benefits which are available in old regime, but you have to leave them in the new regime. Section 1013A, house rent allowance exemption. You will not be allowed in new regime. Section 1014, there are certain exemptions like children education allowance, children hostel allowance, transport allowance, tribal area allowance, uniform allowance, helper allowance. All those exemptions will not be allowed except for, means these four will be allowed. These four will be allowed. The others, education allowance, hostel allowance, tribal area allowance, that you will not get. These four you will get. Transport allowance for Divyang means handicapped employee, which is 3,200 rupees per month. That will be allowed. Normal employees, it is 1,600 per month exemption. Handicapped employees, it is 3,200. Normal employees and handicapped employees both get their exemption in old regime. In new regime, only handicapped will be allowed. Normal wala not allowed. These four will be allowed. Others you have to forego. Whenever you get conveyance allowance for office duties, you take exemption in old regime. You can take in new regime. This is allowed. These are exceptions. I hope you have understood. Anything you are sent on a tour, travel, transfer or away from normal place of duty, you get an exemption in old regime. You can take also in new regime. These four will be allowed. Other than this, children education allowance, hostel allowance, uniform allowance, helper allowance, tribal area allowance, all that will not be allowed in the new regime. Next, section 1017. If you are MP or MLA, you get daily allowance and you get constituency allowance, which is exempt under 1017. Only sitting fees is taxable under IFOS. These are exempt, but exemption is available only in old regime. In new regime, it will be taxable. Whenever income of minor child is clubbed in the hands of parent, parent gets an exemption. Amount clubbed or 1,500, 1,500 rupees per annum per child, whichever is lower. Allowed in old regime, not allowed in new regime. As he said, it's also a chapter. We will be having it in revision. We all know it's a 15-year tax holiday divided in 3 slots of 5 years. Allowed in old, not allowed in new. Section 16, deductions from salary. Standard deduction, actual salary or 50,000, whichever is lower. Entertainment allowance deduction only for government employees. Professional tax only if paid, whether government or non-government. Allowed in old, not allowed in new. Deduction under 24B, interest on SOP, because SOP we don't show income, NAV is 0. So interest deduction not allowed. In LOP, DLOP we show income, interest will be allowed. Interest will be disallowed only under SOP. In LOP, DLOP it will be allowed. Next, additional depreciation. Manufacturers are eligible for additional depreciation. It will be allowed in old regime, not allowed in new regime. Whenever you invest in plant and machinery in backward areas, this was only up to 31,320, so it is irrelevant. Now you can ignore it. It was a deduction earlier available. Now the section is only deleted. You can ignore it if you want. Section 33AB, deduction for tea, coffee, rubber business, and 33ABA, site restoration. These are all PGBP deductions. Allowed in old, not allowed in new. Next, certain provisions of section 35. 35.1.2, contribution to approved scientific research association institution. 35.1.2a, contribution for Indian company doing scientific research. 35.1.3, contribution to approved association doing statistical or social science research. 35.2AA, which is applicable to contribution to national laboratory. These deductions you have to forego. Let me remind you, section 35 scientific research has got total 7 deductions. 35.1.1, 35.1.2, 35.1.3. 35(1)(2)(a), 35(2)(AA), 35(2)(ab), 35 subsection 2. Out of 7, 1 is available only for companies. 35(2)(ab) is available only for companies, in-house scientific research. So that is not applicable because 115 BSc is for individual HUF. So remaining 6. Out of those 6, 1, 2, 3, 4 have to be foregone. 4 have to be foregone. 4 not allowed. That means 2 allowed. In short, there are 2 deductions of section 35 which can be taken in new regime. Only 2. This is not applicable and 4 not allowed. Not allowed in new regime. Out of 7, 1 is not applicable. 2 are allowed. 4 have to be foregone. Which 2 are allowed? 35(1)(1). Revenue expense for own business and 35(2). Capital expense for own business except cost of land. These 2 are allowed. 4 have to be foregone in new regime. And 7th is not applicable only because this is applicable only in company. So we will talk about it in company chapter, not here. 35 AD, 14 specified businesses, 100% deduction of capital expenditure in old regime, not in new regime. 35 CCC, deduction of agriculture expense, extension project, allowed in old regime, not allowed in new regime. Deduction against family pension, 57, clause 2A, deduction against family pension. 1/3 of the pension received or 15,000 per annum, whichever is lower, allowed in old regime. That deduction again will not be allowed in new regime. This is the biggest thing, biggest loss. Chapter 6A deduction will not be, chapter 6A deduction will not be allowed in the new regime. Chapter 6A deduction will be allowed only in the old regime. In the new regime, you will have to forego chapter 6A deduction altogether. This is going to be the biggest loss. But except means these 3 will be allowed. Just like in salary, if you remember, you don't get 10, 14, but these 4 are allowed. They are exceptions. Same manner, chapter 6A deduction not allowed in new regime, but these 3 will be allowed. 1, 80 CCD, 2, only employer contribution. 80 CCD also has subsection 1, also has subsection 1B, which is on own contribution. That will not be allowed. That will not be allowed. Only which one will be allowed? Only employer contribution, because anyways it is first added to salary. So that will be allowed. 80 JJAA to provide employment. We want to promote job creation. So that is going to be allowed. And 80 LA, a deduction for IFSC. 10-year holiday, 10 consecutive years out of first 15 years. 100% deduction of profits for 10 consecutive years out of first 15 years. So that is going to be allowed to IFSC. These 3 are allowed. Everything else, 80C, CCC, 80U, 80G, anything, 80D, medical claim, everything is going to be disallowed. Only these 3 will be allowed. Next, with respect to all the deductions that we have foregone, whether scientific research, whether 35 AD, current year we will not be allowed because we are in new regime. But is it possible? Last year we were in old regime. So we were eligible, but we did not have enough profits. So the losses got carried forward to the current year. Now current year these deductions are not allowed. Brought forward deductions also not allowed. These deductions, whether they pertain to current year or whether they are brought forward from past year, they will not be allowed. Even if past year I was in old regime, if I shift to new regime, they will not be allowed in the current year. Next, house property loss against other incomes. Under set off chapter, it is allowed. Up to 2 lakh rupees of house property loss can be adjusted against other heads of income. It is allowed. But in new regime, it will not be allowed. So house property loss cannot be adjusted against other heads of income under the new taxation regime. And lastly, exemption from any allowance or perquisite which is under other law. For example, in gratuity we have an exemption under section 1010. We have an exemption given under Payment of Gratuity Act. In retrenchment compensation, we have an exemption given under Industrial Dispute Act. This is a salary related point. So more relevant for inter students, less relevant for final CA student. Any allowance or perquisite which is exempt under any other law because of Payment of Gratuity Act or Industrial Dispute Act, that exemption will not be allowed in the new regime. That exemption will be allowed only and only in the old regime. You have to forego these 20 tax benefits, then and only then you will be eligible to get your new regime at the reduced rates and savings of 75,000. Loss can be unlimited. Savings will be only maximum 75,000. Let's go ahead. Now we go to the tax rates of cooperative society. Very easy slabs. First 10,000 10%, next 10,000 20%, and after 20,000 30%. So 10,000, 10%. Next 10,000 up to 20,000, 20%, and then remaining will be 30%. Very, very clear, easy and straightforward tax rates. No rebate, of course, because rebate is applicable only to individual. Now see surcharge. The surcharge that we have studied 10, 15, 25, 37 is for individual, HUF, AOP, BOI, AJP. Individual, HUF, AOP, BOI, AJP. For cooperative societies, surcharge will come only if income exceeds 1 crore. In fact, we all know for company firm also surcharge comes only after 1 crore and only one rate, 12%. Same in partnership firm also. Income more than 1 crore, only one rate of surcharge, that is 12%. And HEC will be applicable at 4% of your basic tax plus surcharge if applicable. So only one rate of surcharge. Income less than or equal to 1 crore, no surcharge. Income more than 1 crore, 12% surcharge, and 4% is going to be the cess. We also have a new taxation regime which is applicable. Now see carefully, here they have mentioned resident cooperative society. That means this will not be applicable if it is a non-resident cooperative society. This will be applicable only and only if it is a resident cooperative society, not applicable for non-resident. So in 115 BAC they did not mention. Okay, and now things will become a little easy for you. First, basic tax is going to be applicable at 22% flat. So no slabs, flat 22. AMT not applicable. No applicability of alternate minimum tax. Surcharge here will be flat 10% and here surcharge will come always. So observe, for cooperative society, in old regime surcharge came only if income crosses 1 crore rupees. Only if income crosses 1 crore. But here surcharge will come always. Fixed rate of surcharge 10%. So 22 will always have. Even if income is 1 rupee, there will be 10% surcharge. Cess, as we are aware, is always applicable anyways at 4%, and special rates will continue to apply. So surcharge cess will be applicable, special rate will also be applicable, alternate minimum tax will not be applicable. Option has to be exercised on or before the due date of filing return. We are all aware of that in all the 4 sections, and here once exercised cannot be changed, shall be applicable to all the future years. Option once taken, you will not be allowed to change this option. Correct? And to take the option, what are the tax benefits to be foregone? Same now if you observe, as he said, additional depreciation, 32 AD is now over, so you can ignore tea, coffee, rubber, site restoration. For scientific research, same 1, 2, 3, 4, same 2 allowed and same not applicable because that is applicable only to company. 35 AD to be foregone, agriculture extension, any chapter 6 deduction not allowed except section 80 LA, and with respect to the above, if there is any loss or brought forward loss, that will also not be allowed. As far as partnership firm, local authority is concerned, we have a separate special chapter, assessment of firms, so we will discuss there, and for companies we have a special chapter, MAT, so we will be discussing that. That's our first chapter revised, introduction. Reminding you, this is revision lecture. We are done with our first chapter, introduction. Let's then continue with our revision lecture. Chapter number 2, double taxation avoidance agreement, which we all know is also called as treaty and convention. So DTAA, DTAC or DTAT, whatever you may want to call it, we are going to provide double taxation relief. And of course, before knowing what is relief, we need to learn first what is double taxation. And one of the most important concepts of international tax, both in paper 7 and paper 6, is this, that globally there are 2 principles of levy of tax: principle of residence, principle of source. If you are the resident of a country, tax resident of a country, then that country will levy tax on you and that country will be called your home country. And if you have source in some other country, if you derive income from other country, that country will be called your host country. The home country will apply the principle of residence and the host country will apply the principle of source. Thus, when resident of one person has income in another country, resident of one person having income in another country, home country will apply principle of residence, host country will apply principle of source, and thus assessee will be made to pay double tax. That is the double taxation that we are talking about. Principle of residence, principle of source, very, very important. However, as we are aware that double taxation will be now classified into 2 categories. First category is juridical, which example we took: resident in one country, income in another country; resident in one country, income in another country. That is nothing but juridical double taxation, when the same income is taxed twice in the hands of same person. For example, I am a resident of India and I have income in New Zealand, for example, rupees 100. India will levy 30% tax. New Zealand, example again, 40% tax, and thus tax in India 30, tax in New Zealand 40. Total tax payable by me is going to be 70. The total tax that I will be paying will be 70. So that means, can I say this tax and this tax is being paid by the same person? This tax and this tax is being paid on the same income, and thus can I say same person, same income getting taxed twice, same person, same income getting taxed twice? That is juridical double taxation for you. Same person, same income getting taxed twice will be juridical double taxation. But when the same income is taxed twice for different persons, again I have an example for this. A company in India pays audit fees to CA 1 lakh in cash. CA will pay tax on his income because it is audit fees received. Once you get income, you have to pay tax under PGBP. However, company will not get deduction. The expense will be disallowed because cash expense greater than 10,000 are disallowed under 48(3), and thus company getting disallowance means company has to add back this under its income, and thus company will also pay tax. That means CA is also paying tax, company is also paying tax. CA, company both. That means same 1 lakh is taxed twice, but different people, once for the company, once for the CA. The difference between juridical double taxation and economic double taxation is that juridical double taxation is on the same person and economic double taxation is on different people. So same person, same income getting taxed twice is juridical, and different people getting taxed is economic double taxation. And now comes the most important point of this chapter, that we will give you relief only in cases of juridical double taxation. The concept of economic double taxation is over after this discussion. When the tax is on two different people, it is economic double taxation, and let's be clear, for this there will be no relief for the simple and plain logic. Check your pocket. No, put your hand in your pocket and check. No, from your pocket tax was paid how many times? Once. No, then why you want relief? Here, check your pocket. Both liabilities went from your pocket, and thus we need to give you some reliefs. Thus relief will be given only under juridical double taxation. Relief will not be given under economic double taxation. Juridical double taxation, there will be relief, but economic double taxation, there will be no relief at all. And thus, to protect the assessee from the genuine hardship of levy of tax on the same income twice in cases of juridical double taxation, we will be having relief. Bilateral relief will be given under section 90 and 90A. Unilateral relief will be given under section 91. When both governments cooperate with each other, sit across a table, they have friendship with each other. Yes. Bro, high five. Oh, high five. Fist pump. When both have friendship with each other, both together enter into an agreement called DTAA or DTAA, agreement, treaty or convention, then it is called bilateral relief. But when he is left alone, 2 minute silence. When you are alone, at that time you will get unilateral relief, only government of India, because there is no cooperation. So if both governments cooperate, they do a treaty, then relief will be according to the treaty, that is unilateral, bilateral relief given in 90 and 90A. But when both governments don't cooperate, then you will get only unilateral relief under section 91. And this chapter is only about learning what is bilateral relief, what is unilateral relief. Once you understand bilateral relief and unilateral relief, chapter is over. Okay, so first thing we started with, globally there are two principles of levy of tax, residence and source. Home country applies residence, host country applies source. When same person pays tax at both places, that's juridical double taxation, that is the relief we are learning. If it is different people, that's economic double taxation, no relief. And when we give relief under juridical only, we have two ways of giving relief. If there is cooperation, there is treaty between the two countries, we call it bilateral relief. If there is no cooperation, only government of India will come forward to provide you relief, that will be unilateral relief. What is a double taxation? Now we are learning bilateral. What is a double taxation avoidance agreement? Agreement between governments of two countries to avoid double taxation. Both governments will agree on certain terms and conditions to reduce the tax of the assessee. Government of India has entered into DTAA with many countries across the globe, roughly about 120 approximately, and all the DTAs are different from each other as far as calculation is concerned. That is, no two DTAAs are same. So, in some DTAAs we will say home country will leave tax. In some DTAA we will say host country will leave tax. Some places they will reduce the rate of tax, but every DTAA will provide for two things definitely. One, it will give you relief from double taxation. That's the main purpose. And second, they will exchange information with each other. So, for example, if there is an agreement between India and Russia, Russia will tell India where Indians have invested money. India will tell Russia if Russians have invested money. They will exchange information with each other. So, they will give you relief and exchange information. Give you relief and exchange of information. The main two things which you will find in every agreement. Calculation may be different, but these two you will find in every agreement. Relief and exchange of information. Now, let's go and learn bilateral relief. Section 90 empowers Government of India to enter into DTAA with foreign governments to give relief where income has been taxed in both countries. And there are two methods of giving relief. One, there is something called tax credit method. Second, there is something called tax exemption method. Under the tax credit method, both countries will take tax. India and New Zealand both will take tax, but one will give you credit. So, if I come back to my example of 30 and 40, here both countries will take tax. If New Zealand is giving credit, that means India you have to pay 30 and New Zealand in 40 you take credit of 30, pay only 10. So, you pay at both places, but one country will give you credit. And if India is giving credit, then New Zealand you pay 40. In India against 30 you will take credit, but it can be maximum 30. Your credit of course cannot be more than your liability. So, both countries will take tax. What is tax credit method? Both countries will take tax. One will give you credit of tax paid in other. And tax exemption method is very easy. Very, very easy. One country will take tax, other country will not take. So, India will leave altogether or New Zealand will leave altogether. So, if both take and one gives you credit, that's tax credit method. If one takes, one does not take, that's exemption method. Which country will give credit or exemption as the case may be, or which method will be followed, everything will be based on what is written in the agreement. Every agreement is different except the common points that we are studying. Next comes again a very, very important point. If the general provisions of Income Tax Act are found to be more beneficial over the specific provisions of DTAA, then to that extent, assessee can seek application of general provisions of income tax. In other words, the provisions of DTAA are a very famous scene from a famous web series. And this I have put star because I cannot actually write those words in a professional book. So, he is basically giving you an option. The DTAA, just like your new regime, that was also option. DTAA is going to be optional. DTAA is not going to be compulsory. Not going to be compulsory. So, if you find normal provisions beneficial, you can take normal provision. Next, agreement similar to DTAA can also be entered between specified association of India and specified association in a territory outside India. So, ICAI can have an agreement with AICPA or CMA Institute of UK or any of those institutes. Mumbai Police can have agreement with Scotland Yard. We can have such agreements also. And now, Government of India can enter into something called TIEA also, Tax Information Exchange Agreement, with countries where there is no people, there is no people control. In countries which are under the control of any kingdom, we can have TIEA, exchange of information. More importance comes of these agreements where that country does not have tax. Imagine UAE, Dubai, no tax. So, we cannot do DTAA because where there is no tax only, where is the question of relief from double taxation? But we still want information. So, what will we do? Tax information exchange agreement. So, you give us tax related information. Next, last year this clause was introduced, misuse prevention. To put it, I will not waste time in reading this for you. Supposingly there is agreement between India and Germany. So, of course, Indians and Germans can take benefit. Now, India-Germany agreement will be created for giving benefit to Indians and Germans. An Australian opens an office in Germany. and wants tax benefit of India-Germany agreement. So that is misuse. Treaty shopping arrangement, that is indirect benefit, will now be prevented. Is a situation where tax resident of one country where there is no treaty with the source country avails tax relief by diverting income from another country. That means Australian is diverting income from Germany, and this is how he is trying to. Australians are cheaters, we all have seen cricket. So they are purposely trying to take tax benefit by showing themselves as Germans, but we will not allow them to take this benefit. That is the misuse prevention clause that we are now introducing. Next, if you claim tax benefit because of being resident, or if you are a non-resident in India, that means you are a resident in some other country. Non-resident in India means resident in other country. Then from that country, you will have to bring this certificate TRC. That country will give you in writing, dear India, this assessee has become resident in our country, and thus this assessee is eligible for tax relief as per our treaty with you. We write these clauses in the treaty. Kindly grant relief, this person is a resident. You have to bring that tax residency certificate, and relief will be given to you only and only if you have that tax residency certificate. Otherwise, relief will not be given to you. Tax residency certificate will be required. Next, non-discrimination clause. To put it in simple language, the tax rate of non-resident will not be higher than tax rate of resident. India-Germany agreement. India is promising Germany that we will not tax Germans more than Indians. Germany is promising India, we will not tax Indians more than Germans. So India is promising we will not tax Germans higher. Germany is promising we will not tax Indians higher. Your people will not be taxed at higher rates. Your people, we promise that your people will not be taxed at higher rates. However, this benefit is not available for company. So foreign company having higher rate of 40% compared to, I know I have not done company tax rates, but this is revision lecture. I will revise in math chapter, but you know that India company tax rates are 30%, 25%. In new regime, you have 20 to 15%. Foreign company does not have new regime. In old regime, higher rate of 40%. The non-discrimination benefit will not be available. Non-discrimination benefit is available only to non-corporate assessee, where tax rate will not be higher than the tax rate for domestic assessees. That's the first part of the chapter, that is bilateral relief. Very few questions are asked and expected. Maximum questions, 99% questions of DTAA chapter come from the topic of unilateral relief under section 91, because this is not dependent on any agreement. Here a specific calculation is given in section 91 and relief will be provided on the basis of that calculation. So you don't have to read any treaty. The relief is given here itself, subject to the following conditions. Unilateral relief will be given only and only if you fulfill the following conditions. Condition 1, the most important of all, you actually don't have to search for anything in the question. If you find this, everything else is satisfied. This is the most important thing. The unilateral relief will be allowed only and only if assessee is resident. Unilateral relief will be allowed only to resident. Unilateral relief will not be allowed to non-residents. Unilateral relief will be allowed only to resident, not allowed to non-resident. Other conditions: income outside India, tax has to be paid outside India, and there should not be any DTAA. Of course, if there is DTAA, then we will take bilateral relief. We are taking unilateral, means that there is no DTAA. Now see, logic, if you want me to explain, this is revision lecture. I cannot explain logic here. Okay, I have an open challenge for anybody in the country who is pursuing CA final or CA inter, that you watch. In CA final specifically, I say watch my first 5 chapters free on YouTube. They are already uploaded. Then if you want to join my class, you join, otherwise you don't join. You join my class only if you are 100% sure. I have seen hundreds of students who join some class and next time, in the next attempt, they come crying to me, sir, I joined this class or that class because all my friends were going, it was someone famous, we saw this, we did this, we went there, but now I regret, I am unhappy, I am not able to understand anything, I don't know the concept. So I don't want anyone to say that about me. Okay, And thus, I clearly say, watch my first 5 chapters. Then if you think that I will be able to do justice to your talent, to your career, if joining my class will help your career, then only join my class. Otherwise, don't join. It is okay. It is okay. I have got enough number of students. If I handle them properly and do justice, I will be a good professional there only. Okay, I am very clear. So, the first 5 chapters, DTAA being one of them, are already in 2 languages, Hindi English mix and English both, have been uploaded on the YouTube channel already. You go scroll the channel, you will find DTAA. So, detailed explanation if you want for any chapter or logic, it can be done only in full course, not even in crash course. Crash course is also only about provisions. We cannot do detailed explanation in crash course also. And that is why I always say, nothing like the full course. Full course is the best. This revision lecture is meant for those students who have already studied the full course. And they should be aware that relief is available only to residents. Non-resident will not get unilateral relief. Other conditions are understood. And what are the steps of computation of relief? Compute the NTTI. Of course, that will include your foreign income also, because if you are resident, foreign income will also be taxable. Calculate tax as per applicable rates. Find out the average rate of tax. That is, this is your tax, this is your income. Tax upon income into 100, 2 upon 1 into 100, average rate of tax in India, and compare it with the foreign country tax rate which will be given to you in the question. So, Indian tax or foreign tax, whichever is lower. Indian rate or foreign rate, whichever is lower. Select the lower. So, Indian total income, Indian total tax, but find out average rate because we have slabs. Compare it with foreign rate. Indian rate or foreign rate, whichever is lower. Indian rate or foreign rate, whichever is lower. That lower rate you apply on the doubly taxed income included in NTTI. Doubly taxed income included in NTTI into the lower rate. That will be your relief. And that you subtract from your tax liability that you have calculated here. That will give you your final tax liability. Mind you, all your TDS advanced tax adjustments are prepaid taxes. So, calculate this tax. Take this relief, that's your final tax, then take credit of TDS, then take. Some people are such idiots, they calculate basic tax and then they adjust TDS. ऐसा कान के नीचे दो लाफा देगा ना खींच के. For North Indians, ओडी चिट्टी अडिक्कुम थल्ली कुल्लुम for South Indians. Basic tax, rebate, surcharge, HEC, all these reliefs, that there is something called MAT credit that will give you your final tax liability. This is what I have to pay to the government, final tax liability. Now check your prepaid taxes, advanced tax, TDS, TCS, adjust, and then you can have a final amount payable or refundable also. It can be payable or refundable. Okay, so prepaid taxes will be adjusted last. So what will be your relief? This tax minus this relief will be your final tax. Relief will be calculated how? Doubly taxed income included in NTTI into lower rate. So, income, tax, average rate, foreign rate given, whichever is lower, doubly taxed income into lower rate. Doubly taxed income into lower rate. To give you an example, Indian income of 8 lakh, foreign income of 7 lakh. And the foreign income is from a country A where there is no DTAA and foreign rate is 20. Foreign rate has to be given. Assessee has to be a resident. This is the most important condition. What is the first step? Take the total income. So, Indian income, foreign income, total. On this, calculate tax. If there is no information about deductions or exemptions, anything, that means it is better to go in the new regime. If there are deductions and exemptions, then you will have to calculate both as per old, as per new. But if there is no such information, then calculate tax as per new regime, because that will be beneficial. So, we calculated tax as per 115 BAC, we get average rate of tax at 13%, foreign rate given to us in the question is 20, lower of the two will be 13%, lower of the two will be 13%. What will be our relief? Doubly tax income included in NTTI, that's 7 lakh. You have not paid double tax on 15 lakh, 8 lakh is Indian income, it was taxed only in India. Foreign income of 7 lakh is getting taxed twice. So, 7 lakh into 13%, 91,000 will be your relief, and final step we will do only if it is asked. This was your tax liability 195 when you did not have any relief. From that you took this relief of 91, 195 minus 91 will give you your final tax liability of 1,04,000. So, total income, total tax, average rate, foreign rate, whichever is lower, doubly tax income included in NTTI into lower rate, that's your total relief and subtract the relief from your tax liability, you get your final tax payable. That was your second chapter, double taxation relief. Second chapter, double taxation relief. We go ahead in the order of the index. Third chapter, mode of acceptance and repayment of loan, advance or deposit. Whenever you take a loan or you repay a loan, accept a loan or repay, accept or repay, in what mode you should do. To curb cash in the economy, this chapter was introduced. When an assessee was caught holding huge amount of cash, you were caught with physical cash. Assessee used to escape the levy of tax, interest and penalty by saying this. Some say, sir, Hera Fairy is a Bollywood movie, so how do you expect South Indians to know this? But just to tell you that Hera Fairy was actually copied from a Malayalam movie, Ramji Rao speaking. Or maybe it was a Telugu movie, but it was a remake of a South movie. Of course, then the Hindi version also became very, very famous. Most of the Bollywood movies are primarily on remake of all the most good movies. If you see, they are remake of South movies. They used to take content from South and make it in Bollywood with stupid actors, poor actors. Now, South industry also have become very clever. Very clever. They now make movies in their own language and they dub that movie only in Hindi. They know that if we dub it in Hindi, then across the country they will get audience. So they dub it. Why should we allow Bollywood to remake? अरे समझा क्या? तो basically assessee was escaping tax, interest, penalty, everything, and thus we created two sections in income tax. 269 SS is on taking of loan and 269T is about repayment of loans. Very small chapter. Next chapter, NRI taxation, is a little big. So today, even if we don't complete the full 2 hours, we will still wind up even before 2 hours, because if I finish a chapter, then I will stop at this. We may not have full 2 hours. Okay. And NRI is an important chapter. So I want you in a fresh mind. Otherwise, I would have started and kept it in between also. We may change the system in the future lectures. Okay. So first, 269 SS. No person shall take or accept, as I told you, that this is on taking a loan, advance or a deposit. Loan or deposit or advance for sale of property, which we know by the name of token, otherwise than the 3 allowable modes. In the entire book, again and again you will find the term 3 allowable modes, 3 allowable modes. What are we talking about? Account paid check, where payer and receiver are traceable. Account paid draft, where payer and receiver are traceable. Electronic clearing system through a bank account or any other prescribed electronic mode like BHIM, UPI, any of these modes. No person shall take any loan or advance other than these modes. In short, we wanted to curb cash in the economy. So in other words, can I say you cannot take a cash loan? These modes you can take whatever you want, but you will not be allowed to take cash loan if the amount of the loan that you are taking, and plus if you have already taken some loan from the same party including interest, and that can be taken in any mode. So earlier I have taken 1 lakh in check only, but that amount will also be taken for the total purposes. So today's loan plus past loan, today's loan plus past loan, that total, if it is exact 20,000 also, then today's loan you cannot take in cash. The past loan, even if it was taken in check for the limit of 20,000, we will take it. In other words, supposingly I am taking 5,000 loan in cash. See, today if I am taking check or online, no, then this section is only not applicable. In cash I am taking 5,000. I will check past loans. Say past there is 10,000. So total is less than 20, ignore. Past there is 15. Now that 15 can be in any mode. For 20 limit we will take it. If past there is already 15 and the total is coming to exact 20 also equal to is covered here, then I cannot take cash. Then today's 5,000 has to be taken in the 3 allowable modes. If the current loan plus past outstanding of any mode, current loan plus past outstanding of any mode, obviously of the same party, we are keeping the data party wise. If it is 20,000 or more, then you have to take in the 3 allowable modes, otherwise there will be penalty on you. Penalty we will discuss, but there are some cases where this section only is not applicable. Any loan that is taken from the government or by the government. So you take from government or government takes from you, like this. From or by government, government company, statutory corporation like ICAI, loan taken from or by bank, any other notified institution. If the lender and borrower are both farmers and they don't have any other income, then in these cases 269SS is not applicable. You can take any amount of loan in any mode because the provision is not going to be applicable. So except these exceptions, if you take a loan where your total is touching 20, old loan plus new loan, old in any mode but from the same party, if the total is touching 20, then you have to take in allowed modes, otherwise you will be liable for penalty. You will be liable for penalty. What will be the penalty amount? 100%. So equivalent to the amount of loan, advance or deposit taken in violation of 269SS on the person who has taken. On the giver there is no problem. Giver is always immune. The person who is the lender has got no problem. Check carefully. Section is created for the borrower, the acceptor, the taker. So lender will never have any problem. 100% of the loan, advance or deposit taken in violation will become your penalty. 100% of the loan, advance or deposit taken in violation will become your penalty. Equivalent to the amount means 100% of the amount. So in short, loan of 20,000 or more, total loan of 20,000 or more, even if you have taken in the past, we will add that for the total purpose. You have to take, equal to 20 also is covered, you have to take in the 3 allowable modes, otherwise you will be liable for penalty. But certain points to be noted, some case laws. If there is a genuine transaction, then there is no penalty. We already know. This is revision lecture. I don't want to remind you again and again. Section 273B of income tax, no penalty if there is reasonable cause. Transaction between sister concern, no penalty. If you do through transfer vouchers of bank, you have to fill in the transfer voucher. It is done through bank, though not account pay, check, draft or electronic mode, but allowed because done through bank. No penalty shall be imposed. Partner's contribution to firm is capital. It is not loan, advance or deposit. If there was a genuine intention of the assessee, then there will be no penalty that will be applicable. If contribution towards the share capital, share application money taken by the company, company receives share application money, no, that will not be treated as loan, advance, deposit. So no penalty. Next we have a Rajasthan Ico decision which is not followed by ICAI. If I take 21,000 cash loan, Rajasthan High Court levies penalty only of 1,000. Only amount more than 20. Only one. But ICAI will levy penalty of full 21,000. And that is only sensible. Because if I take exact 20, that is also violation, no? Because equal to 20 is also covered. As per Rajasthan High Court, there will be no penalty. But as per ICAI, correctly, there will be 20,000 penalty. The AO can invoke this penalty for violation of 269SS, or he can call your amount unexplained cash. He cannot invoke both. He cannot accept your loan argument and still call it concealed income. He has to decide concealment penalty or loan penalty, concealment penalty or loan penalty. Only one of them will be applicable. He will not be applying both of them on you. Okay. And the second part of the chapter, that in future, whenever you have to repay the loan, you have to repay once you take, you are, nobody is Vijay Mallya. Vijay Mallya is also not allowed. If you have to repay loan, you have to repay loan in the 3 allowable modes again: account pay check, account pay draft or electronic mode. If the amount before repaying is 20,000, see, after repayment you can make it 0 also. Before repayment, if the outstanding is 20,000 or more. So if there is 1 lakh loan outstanding, after repayment it can become 0 if I repay full. Before repayment, what is the amount? 1 lakh. If the amount before repayment is 20,000 or more, then you have to repay in the 3 allowable modes, otherwise same penalty. And for property advance, if there are, say, multiple buyers or multiple sellers, then we will check the total. Supposingly I am selling a property to 3 people, X, Y, Z, and I have got token of 10,000 each. Okay. So when we will check repayment of the token, in case X, Y, Z are returning my token, then at the time of repayment, what is to be checked is the total outstanding. See, X only has to repay 10, Y has to repay 10, Z has to repay 10. Individually it is only 10, but the total is 20 or more, then you have to repay in the allowed mode. Supposingly X repays in cash, X will be liable for penalty. After repayment by X, the outstanding is 20. Total we have to check. So Z or Y also has to repay in the allowed mode because exact 20 is also covered. But after Y repays, Z can repay in cash also because individual and total both outstanding are 10. So we have to see the total outstanding. Exceptions of 269T are absolutely same as 269 SS, government, government company, statutory corporation, bank, notified institution, lender and borrower, both farmers, and penalty also is absolutely same. 100% of the loan, advance or deposit being repaid, and it will be levied on the person who has repaid the amount in violation of 269T. So, violation of 269 SS 100% penalty, violation of 269T 100% penalty. In both cases you will be liable for 100% penalty. However, there will be no cumulative penalty under section 271D and E. So, if I take a loan and I have already paid penalty, then at the time of repayment I will not be liable for penalty again. If you have paid penalty at the time of taking the loan, then you will not be paying penalty again at the time of repayment of loan. That was our chapter 269 SS and 269T cash loans chapter. I hope you were comfortable with the lecture. We will be having the similar sessions every day. Only first day I am keeping less duration. From tomorrow onwards, it is going to be full 2 hours. If you are comfortable, then you can continue with me, and if you want, preferably, as I told you already, that it is advisable that you have the handwritten book for your revision. This is a revision book. Have a nice time, please. Thank you very much for joining. Have a good night. Thank you very much. Bye bye.